Every head of markets research Asia Pacific Rabobank, and Ben Luke, global market strategist at JPMorgan Asset Management, join in to discuss this afternoon, gentlemen. Ben, I'll come to you first. We're now seeing the Shanghai markets give negative returns on a year-to-date basis. It's down 2% from the hefty 40% gains that we were once staring at. How much lower do you think China can go to this year itself?
I think if you actually look back at the rally actually started in 2014. So when you actually think about from 2014, there is still quite a substantial amount of profit there. I think overall what we're seeing is that we still need to see basically the Chinese government to push through with further fiscal and monetary stimulus in order to stabilize the Chinese economy. At this moment, I think that there's still downside risk, so we would be expecting more downside pressure for the A-share market.
Okay, Michael, a similar question, but not restricted to China really. We've seen a torrential amount of selling in Asian markets as well as on Wall Street. Today we are seeing some green shoots, or if you please, Dow futures indicating a 130, 140 up. Is an exhaustion of selling brief, or do you think markets are finding their feet?
Oh, I don't think markets are finding their feet. I think it's just a dead cat bounce or a technical bounce, or some last vestiges of the inherent optimists which seem to always flock to the U.S. markets after we see a sell-off. But if you look at the backdrop, the data are poor, or they were yesterday, and at the same time the Federal Reserve are making very clear noises that they intend to raise interest rates anyway. So it's the worst of all possible backdrops for markets, and at the same time key global emerging markets, and China in particular, are still continuing to slow down. And we're only seeing the equity market in China stabilize around these levels because of active intervention from the PBOC, which in the long run, is not sustainable and is self-defeating. We were down around 4.5% at the open this morning and suddenly rocketed back upwards again.
That's true. Ben, what's the in-house research in JPMorgan telling you about the internal dynamics of the Chinese economy? Does it get much slower?
Yeah, I think the message is pretty clear, and that is I don't think the Chinese government at this moment is going to push through with further and further intervention into the overall equity market. What you need to see at the bottom line is that you need to see a stabilization in the Chinese growth story.
No, Ben,
I think overall, I mean, if you look at obviously the cyclical...
Ben, yes. I'm not at the moment asking you about the stock markets at all in China. I'm asking you what's the in-house research telling you on the Chinese economy as a response to that Caxin number, PMI number, and the official PMI. Are you all reading that this high-frequency data will get worse, much worse?
Yes. I think that's definitely correct. If we look at the manufacturing and also the realistic numbers, that continues to actually go down, at least on the investment side. What we are seeing on a positive note definitely is that property prices and obsolete property sales transactions are going up, at least for the fourth consecutive month already. So we are seeing that basically the tier 1 and the tier 2 cities, the overall property prices have stabilized. But what we're still not seeing is that this is still what we call a destocking mode, meaning that both overall property developers are just selling what they have already built. What we're still missing is basically property construction and investments. So if we have basically right now where we have a weak manufacturing based on the PMI number and also not so much of a boost from basically the real estate side, what is left as an investment story for China remains to be the infrastructural spendings. And that we're clearly seeing because previously the Chinese government has already pushed through more injections and liquidities into the policy banks. And the policy banks themselves have also been asked to issue special bonds. Because if you actually look at the Chinese economy, 75% of the bonds that are issued by the policy banks will be purchased by the commercial banks. So what this actually means to us is that the Chinese government is clearly injecting liquidity by themselves, and also they're asking the commercial banks to also push in liquidity into the policy banks so that they can push into further infrastructural spendings. What we are seeing is that railway investments as well as water and waste management, those are the projects that are obviously pushing through with stronger growth and investment right now. So in basically the remaining of the months for 2015, we need to obviously see further push through of infrastructural spendings to stabilize the Chinese economy on the one hand, and while on the other hand we need to see further property activities overall for the next couple of months.
Okay, Michael, would it be better for the global markets, maybe when you're talking about it from a December 2015 perspective, that the Fed does move in September itself, so that risk event is then eventually out of the way? Or do you think that there would be more volatility once the Fed does move?
Well, I think we're damned if we do and damned if we don't, to be honest. If the Fed do raise rates, that's the last thing that the global market needs at the moment. Tighter monetary policy set globally by the Fed, just when the real economy is so weak and stumbling in so many places. I absolutely agree. China has got some pockets of strength, or more than pockets, some areas of strength, but it also has significant areas of weakness. And, more than enough that the last thing they need to see is a backdrop of higher global interest rates. At the same time, if the Fed don't hike rates, you have to say, what does that tell you about how strong this global recovery is? That, coming up for a decade after the GFC, they're still not even able to raise interest rates 25 basis points. I think that tells you all you would need to know about what a pickle we are in globally, particularly because in the background, I seem to be hearing something that I concur with, which is that China is going to be increasing monetary stimulus even further, at which point, how long would it be, hypothetically, until we have zero rates in the US and Europe and Japan and China? What would that tell you about how strong the global economy is?
Okay, then what do you do with money that you have to invest? Are you getting into cash? Which kind of cash? Dollar cash? Non-dollar cash? And just a related question, the Chinese have to be selling US Treasuries because of the intervention they're doing in the FX markets. How do we factor that into yield movements?
Yeah, I think if you actually look back at what the Chinese government is doing, obviously intervening with the FX market means that they have to obviously sell the treasuries. Obviously, for us, this is what we call the impossible trinity situation that China has to focus on. Whether or not they have to give up exchange rate is the most important thing that we're seeing right now. If they need to really provide clear enough domestic liquidity to the Chinese situation, they have to actually release or basically have a more free flow exchange rate. Because what they're doing is once they're trying to support basically the exchange rate, the renminbi, they're actually pulling renminbi out from the liquidity system. So that's what we're seeing right now, is that the repo rates or the interbank 7 days rates that we track for the Chinese economy, that has not been going down fast enough. So on the one hand, we do need to see further and further stimulus, but on the other hand, we do need to see what we're most hopeful is obviously letting the interest rate actually have a free bound.
Okay,
yeah.
Actually, that question was also to Michael. Michael, what would you buy, if at all, and how are you interpreting the Chinese selling of treasuries?
Okay, well, the first question first. I think you can probably tell from my general tone that I'm fairly risk-averse in terms of how I see things. So my own personal portfolio, I've been in cash for a very long period of time, and I may be missing out on the upside, but I'd rather do that for a while than take a 15-20% hit to the downside. In terms of the Chinese selling of treasuries, I broadly concur with everything that Ben was just saying, and I do think something is going to have to give here, and my personal view is that it's likely to be the exchange rate. Because I think that beyond a certain political dynamic that says that China should have a stronger exchange rate because it's a larger and larger economy as a share of the global economy, actually right now it looks overvalued to me, and I don't see what long-run value there is in China in maintaining a peg at an artificially high level when if it were allowed to float more freely and if it could find its own level, there wouldn't be capital outflows and everything would be looking that much healthier.
Okay. All right, Michael, as well as Ben, thank you very much for joining in. Well, the